Hello, everybody. My name is Alesh Eisner, and welcome to the Canadian Money Talk, the channel about Canadian investing and personal finance. Please like and subscribe. I record 2 videos per week, so make sure you ring the notification bell to get notified each time one comes out. I had a question in a previous video on how to judge whether a stock is too expensive. So the question was, could you please make a video on how to know if the price of a business is at a discount and margin of safety? Which valuation metrics would you use to determine that? Maybe a real life scenario. And then a follow-up was just want to assure myself that I'm not overpaying for a stock. So there's multiple methods to value a stock and make sure that it's not overpriced. The first and foremost for me is the price to earnings ratio. So that's price per share divided by the earnings or profits per share. And how you interpret this is how much are you paying for a dollar of profits, or how many years will it take for the company to make back in profits how much you paid for it. A high PE stock is trading on sentiment, expecting a lot of future cash flows and profits which may not materialize. I stay away from high PE stocks, preferring high single digits to teens for the PE. If PE is undefined or negative, the company is actually not profitable, and I definitely avoid those. The profits and earnings, which are the fundamentals and lifeblood of a business, are a good way to determine whether you are buying something that's underpriced or overpriced. Look at the future predicted profits to see how it will make investors money. The second ratio I use is price to book. So this is price per share divided by net assets, which is assets minus liabilities. It means how much are you paying for a dollar of net assets. If this ratio is less than 1, that means that the company, if it were to stop doing business today, would pay you out more when it liquidated all of its assets than how much I paid for it. There's different sectors which have different averages for both the price to earnings and price to book. Financials are near the lowest for both price to earnings and price to book, while healthcare tends to be the highest. Make sure to put these two metrics in context and don't compare companies from different sectors, since it's apples and oranges. Compare the company to its sector and see how it is for price to book and price to earnings. Also, look at the past and average PE and PB for the company itself and see what its average has been in the past and whether it is lower or higher today. This may not be available for all companies, but lower today means the company is trading at a discount. The third ratio is price to cash flow. This is a measure of price per share divided by free cash flows. Free cash flows are operating cash flow minus capital expenditures and are reduced for tax, but not for amortization or depreciation, since those two aren't cash items. This is how much you're paying for a dollar of cash flow, which some experts prefer to profits, since profits include deductions for amortization and depreciation, which aren't quote-unquote real expenses, but are just for accounting purposes to reduce taxes. The fourth measure that I use is discounted cash flow models, or analysts' fair value of the stock. The discounted cash flow model is used to evaluate stocks to get a quote fair or present value. It uses two key concepts. Number one is time value of money, where a dollar today is worth more than a dollar tomorrow. And two, a series of future cash flows are what any asset is worth today. So it uses the free cash flows as I defined earlier, and the model discounts the future free cash flows to the present at the going interest rate. The higher the rate, the higher the discount on the future cash flows. This is why stocks took a hit when interest rates were going to rise in November 2021. The present value fell, especially on growth and speculative stocks that would have positive cash flows far in the future. I don't create my own DCF models since it is really a guesstimate of what the future cash flows will be. Anything more than a year or two out is a bit of a guess, even if you are using companies' estimated growth rates from their reports. Plus, the discount rate makes a huge difference in the valuation. I'm also not sure if I subscribe to a change in the interest rate so significantly affecting a stock's valuation. Now, I do use the fair value that analysts calculate using this method, but I use it as a guide, not as a sell target. Now, my main brokerage, Qtrade, uses both Morningstar and Desjardins research fair value, and Desjardins is always higher. So they are using a different interest rate or different cash flows. So to summarize, try to buy stocks whose current price is lower than the fair market value or possibly a consensus of fair market values. In general, don't go for stocks that have been pumped up by sentiment and future hopes and expectations of future profits. People often pile in after a stock has already been rising for a while when they have FOMO, fear of missing out, which keeps the stock going up past any reasonable fundamentals. Whomever gets in at the top loses their shirt when the market realizes what has happened. Cooler heads finally prevail and everybody gets out while taking profits. And as Benjamin Graham and then Warren Buffett said, in the short run, the market is a voting machine, but in the long run, it is a weighing machine. Things always go back to fundamental valuations, which is generally is the company making a profit. So go for quality stocks that have profits today with a low PE so you aren't overpaying. So if you have any requests on what you'd like me to cover in future videos, please put that into the comment section. Please like, subscribe, ring the notification bell, and may you have a profitable day.